Hey, good afternoon, everybody. This is your market update for January 26th, one step closer to the weekend, almost there. I hope everybody's had a great week. So we'll jump right into it. Initially this morning, futures had indicated that the stock market was set to open modestly positive, which it did in fact. But then the gross domestic product GDP report came out and showed that economic growth was better than anticipated in the fourth quarter of 2022. So the stock market rallied on that news. I think the Dow at one point in time was up about 200 points. It's since then turned negative, I think currently down about 77 points. S&P 500 and NASDAQ both up on the day. So that's a good thing. Initial jobless claims for last week, which is basically the report that indicates how many people filed for new unemployment claims, was actually lower than anticipated. So continuing to support a tight labor market, resiliency in the labor market, which is certainly a good thing. With that said, in the last couple of months, retail sales have been less than stellar. Manufacturing numbers have also been less than stellar. Those figures would help to support, that recessionary period is on the way. So mixed signals in the marketplace right now. I think that the Dow kind of turning negative is due to the market's still being concerned about, the Fed's impact on the economy and throwing us into a recession. Certainly kind of going back and forth today. We'll wait and see what the rest of the day holds. There's still a lot of corporate earnings reports that are set to come out, which could certainly have an impact on the market. Mortgage-backed securities started the day, let's see here, down 11 basis points after ending the day positive yesterday. Currently down 19 basis points. So, after a couple of decent days, especially with the rallies that we've seen in the afternoon in mortgage-backed securities, today started off the day kind of on a downtrend, but a modest downtrend. Again, all eyes kind of on the PCE report that's coming out tomorrow, which is that key measure of inflation, that report that the Federal Reserve is going to look very strongly at, especially before their meeting that occurs on January 29th and February 1st, where they'll basically indicate what the next Fed funds rate hike is going to be. The market's priced in about a 99.7% chance that the Fed's going to increase the Fed funds rate by 25 basis points, which is 0.25%. If for any reason they hike more than that, then likely the market will react negatively, both in the stock market as well as the bond market, which would be not good for mortgage rates. Mortgage rates would likely get worse, but we don't anticipate that's going to be the case. If for any reason they indicate that they're going to pause rate hikes or even talk about the possibility of cutting rates, which we do not anticipate in any way, shape, or form, but the Fed sometimes will surprise you. If that was the case, then the market would likely rally and interest rates would get considerably better. What we expect will happen is that they will raise interest rates, the Fed funds rate, by 25 basis points as expected, depending upon the verbiage in their statement at the culmination of the meeting. That will potentially be market friendly, hopefully. So we'll wait and see. Keep our fingers crossed, say a little prayer. In the meantime, I hope you guys have a great afternoon, and I'll see you in the morning. Thanks so much.